Hello, everyone. Podcast here to explain Chapter 7 and the ins and outs of self-employment and the issues that tax issues with regard to having your own business. So let's get right in here and review the cash method versus the accrual method. Remember that if you have your own business, most people who have their own business are going to be on the cash method, and they're going to constructively receive income when it's credited to their account or made available. So if somebody delivers them a check, that's income even if they don't cash it till the next month or next year. Accrual is recorded as when they're earned or accrued. This is what you learned in Accounting 101 and things like that, but typically, until a company gets quite large, they don't use the accrual method for tax purposes. Most people use the cash method. So we talked about this in Chapter 3, so this is sort of review. Here are some examples of what we consider self-employment income. And that's important because self-employment income is going to be subject to self-employment tax. Self-employment income is subject to income tax just like any other income, but the self-employment tax is only on the things that are considered self-employment income. Notice that partners in a partnership, and we'll talk much more about that at the end of the course, but is part of your self-employment income. There's some examples of things that are not. So interest, gains and losses, your wages and tips, rental income, that sort of thing, dividends, that are all not, none of those are self-employment income. So if you have this income that you're generating, you also can take expenses to reduce the amount that is taxable. Here's some of the things. Do note that under the new tax law in 2018, meals are partially deductible, but entertainment has gone away. So you can cross that off the list as something that is no longer deductible under the new tax law. All of this is reported on Schedule C. That's a schedule to the 1040. So a little bit about how that looks at. Top is information about the business, some questions, yes or no, and the address, tax ID number, that sort of thing. This is where you calculate your gross profit, if you will. Revenues minus cost of goods sold minus returns, that sort of thing. And this is your gross profit, is what we called it in your accounting courses. And that's where accounting and tax accounting obviously intersect here. And the cost of goods sold is calculated using inventory. Remember, beginning inventory plus purchases minus ending inventory equals cost of goods sold. That's on the back side of the Schedule C, page 2. And then here are some of the expenses. Now, just because it's not on here doesn't mean you can't deduct it. It just means that these are the ones that the IRS sees most commonly. And then if there's others, it totals down here under other deductions and listed on page 2. This is that same page as we did the cost of goods sold, second page of the Schedule C. So some of the things that come up most often with self-employed individuals, those with their own business. First of all is car and truck expenses. You can either use the actual cost method, or no, this is the business use portion. So vehicles are looked at pretty carefully by the IRS because they know that you can use your car during the day for business, but then for personal at night. And so they are expecting a certain amount of documentation about how you use it in the business. The actual cost is you got to track, gas and repairs and all that sort of thing, and take the part of that that applies to business. So if you use it half for business and half for personal, you add up all your costs, take half and half. Half of it would be deductible, the other half would not be. The other way to do it is using the per diem or standard rate of mileage. Instead of having to track all your receipts and all the different costs, you just keep track of your mileage and how many miles you went for business versus personal. And then you add to that, and then you multiply that mileage by 0.545, 54.5 cents. Parking and tolls is always in addition to the mileage amount. All right, pension and profit sharing plans. You'll often see that you can't do this as a sole proprietor or as a Schedule C, but it's not true. You just have it's a little more convoluted way to do it. However, if you may have employees and somebody with a Schedule C could have employees. If you put money in their profit sharing plan or pension plan, that's deducted right on your Schedule C. If you make a contribution to your own, that goes on page 1 of the 1040, okay? Or actually now the Schedule 1 of Form 8, 1040. Different types of plans, defined benefit plans are almost non-existent because it requires so much work to calculate how much you need to put into the plan to get the defined benefit. Defined contribution is what you're most familiar with. SEP plans, 401k, you've heard of, simple plans. This is where there's no promise that there will be a certain amount of benefits at the end. We just promise that we'll put a certain amount in. So it's defined contribution, not a defined benefit. Travel, you can deduct what you pay for business-related travel for yourselves and employees. And if you reimburse your employees under an accountable plan, meaning if they give you the receipts or tell you that and you reimburse them, write them a check to reimburse that, that is a travel expense. And it should be recorded on the Schedule C there. Remember, entertainment is no longer deductible, just the travel and the meals. If you have a non-accountable reimbursement, meaning you say to an employee, I'll give you $400 a month because I know you spend a lot of time driving around in your car and going to different places and spend a lot of money on meals and other things. So you don't have to track your expense. You don't have to bring back receipts. So I'm just going to give you $400 a month. That's actually just wages, and that's how it should be accounted for tax purposes. All right, so it should be under, that's a non-accountable plan because you don't requiring them to make an accounting of their expenses. So these are the things that might be included in travel. Dry cleaning while you're on the road is sometimes forgotten, and if you needed something for a meeting and you have to get it cleaned because you spilled something on the way in the airport or something. Only 50% of meals, no entertainment. Only 50% for the meals part. Car rentals, tips, that sort of thing. What about if you do both? If you go on a business trip, but you also do personal things, you can allocate the cost between the two. If you prepare for an airfare and the primary reason you go is for business, then you get to deduct the whole airfare, even though you spend some part of it visiting Aunt Gerda or something. If that IRS can claim that it was the primary reason wasn't traveling, wasn't to go to business, they could disallow that. So you need to note that it wasn't that you were visiting Aunt Gerda and decided to go to a business conference. It's that you were going to a business conference and decided to see Aunt Gerda. Okay. Foreign travel is a little more stringent, meaning you have to allocate between the cost of your airfare between business and personal, unless you didn't have any control, and the trip lasts less than 8 days, which is an awful lot. Those trips aren't going to be more than 8 days. And the personal portion of the trip is less than 25%. So now comes into how much of the trip is personal versus business. So you have a little higher standard for foreign travel, going outside the United States, than you do domestic travel. Okay. And the same thing with like hotels and stuff. You separate it between the business part of your trip and the personal. Meals the same way. All right, education for the employees and owner, as long as they does not prepare you for the minimum education requirements of the present profession or qualify them for a new trade or business. So you have to be careful that it's not for a new trade or business. And then you have to maintain or improve your skills or required by law to keep your status. So for instance, my continuing professional education as a CPA is required by law, and therefore it is deductible as education expense. It includes tuition, books, transportation to get to the conference or whatever you're learning, meals if it's provided there, that sort of thing. Most of the time the meals are part of the registration, and so you can deduct the whole thing. You don't have to worry about that 50% rule. But also lodging, if you have an overnight conference or something like that where you go for education. Business gifts. Oh, this is our favorite one, but it's very limited. Only $25 per individual. However, you can give out as many pens as you want. This is kind of let's refer to it as the pen exception. Okay, if you print something on it, a mug, a pen, some other giveaway type thing, you can do that, and it doesn't count towards your 25. Give those to as many people as you want, as many times. Any of these things, display racks are not considered gifts. And then if you do any engraving and packaging, it doesn't count. So you might say this is the turkey rule, meaning you can give your customers a gift of a turkey once a year, and it's deductible. And theoretically, if you give them anything more than that, it is not deductible. Perhaps one of the most ignored parts of the tax law. But there's the rule. Business bad debts. That means you made a loan to someone in order to further your business. That's the point. You had to go into this, do this loan so that you could improve your business, and then they couldn't pay you. All right? So we deduct it on the Schedule C. If it's not business, if it just happens to be to someone that you know from business or something like that, those are short-term capital losses. So those are non-business bad debt. So a business bad debt is a loan in order to further improve your business. It has to be a direct write-off. There's no allowance for bad debts, no estimated amount. You have to have made every effort to collect and then have it not work to collect. Okay, and then the other thing that we remember is that if we're on the cash basis, we have no accounts receivable. So while you may track people who owe you money for your business, you don't report it as income until you actually receive the money if you're on the cash basis. That means you can never have a business bad debt because you don't have any income until you receive money. So you can't have a deduction against that income for people that don't pay you because you never counted it as income in the first place. Okay, so a cash basis taxpayer cannot have a bad debt in terms of accounts receivable. They could still make, say, a loan to a business for to further their business and have a business bad debt, but accounts receivable are not part of the business, so it can't write off accounts receivable. All right, we'll stop there and move on in part 2 to the home office deduction.